Thank you, Janice, and good morning, everyone. Appreciate all of you joining this earnings call of CAMS for the third quarter. We will begin the presentation. It'll last about 20 minutes, and then we should have enough time for Q&A. Post that. So, just like all of you understand, and I'll talk about our core business first, the Indian mutual funds market has undergone a change in sentiment starting from the months of June, July. You've seen fairly significant and scaled level of activities across all the core segments in the arena. Riding on all of that, as far as 3Q for us is concerned, our overall assets, the AUM of CAMS service funds, was at a historical high of 26.7 lakh crore, which is a fairly large expansion both year and year and quarter on quarter. We also saw lifetime highs in transactions. You know, this is a good metric to watch in terms of consumer engagement. 2 quarters back, this number used to be in the range of 80 million, grew to about 100 million in the previous quarter in 2Q. And in 3Q, we did over 11 crore transactions, so about 110 million. SIP registrations, which represent the solid, continuous, repeatable part of the consumer franchise, scale to almost the same number or similar number that we had done in 2Q, so 43 lakh new registrations, which is a fairly scaled number. Our overall SIP book grew 9% in this quarter, riding on 2 trends. One trend, of course, is new SIPs coming in. The other is, given the buoyancy in the markets and investor interest, the rate of cancellations or exits was much lower, so that grew about 9%. And then if you take equity AUM as the core metric of the industry, which represents a lot of retail participation, then for CAMS service funds, this number grew by over 8%, 8.3% over the last quarter. The accent was strong on digital, continued to be strong on the digital side. That's how consumers continue to interface and interact with us. CAMS digital properties now represent an aggregate AUM. You know, this is the sigma of all the investors who have participated or registered with our digital properties. That is just short of 8 lakh crore at about 7.9. Our websites continue to be very popular for a variety of reasons and hosted over 11 lakh visitors every month on an average. My CAMS Investor app continued to show regular momentum. Over 1 million users logged in to this app every month. October showed over 10 million, that is 1 crore user sessions, which was a significant milestone for us. In terms of active users, which means users who like to come a few times in a week or sometimes every day to monitor and transact. And MF Central, as you know, was a specific digital property built by the 2 MF RTAs in response to stimulus and guidance from SEBI. That went live in September. It has over 1.25 lakh registrations in the very first quarter, which is October, November, December, since the launch. This was a website-only property, now is available on both the Android and iOS apps, and will continue to get into non-financial and financial transactions in the next 2 months. On the other elements outside of mutual funds, we continue to see significant momentum in the AIF and PMS business. Signed up 11 new customers at the rate of almost 1 a week. CAMS WealthServ, which is envisages to change deeply entrenched habits of consumers by transacting on paper, especially on the AIF side, has continued to gain momentum. We have 15 sign-ups, 6 in the last quarter. We also commenced operations in the Gift City, and in the quarter, 2 new clients signed up to get service from the Gift City. That office is now operational with staff and services. Our CRA platform is progressing well and is due to get into a soft launch within this month, within the month of February, and then into a full-fledged commercial launch starting with ENPS, and then going into the corporate sector with POPs in the month of March. And lastly, our account aggregator platform is now live. You know, there are There were 4 banks active, now there are 8. A couple of the big banks have been testing for some time. They're slightly delayed in joining, but this number should expand beyond 8 quickly. Additionally, on the TSP side, which is the technology service provider side, Findute, a platform put out by Sterling Software, has seen a lot of interest. Across the TSP and AA, which is the richest way to engage with this market for a supplier like us, when you sign up the same client for both TSP and AA, across the companies, of course. There are now 10 sign-ups, all waiting to go live over the coming week. And like we said earlier, because the AA license remains on tap, there are, of course, 5 licensed entities, 4 with products out. 1 will get the product out over a period of time. On the TSP side, it's more. It's almost 20 entities that we see participating, although it's not a specific license activity yet. So accurate counts are not available, but you can easily think of it as 18 to 20 entities which continue to participate in the marketplace. A little more on the account aggregator side, like I said, 8 new entities are live in the AA ecosystem. There is push from the regulators and onto PSU banks, etc., to participate. Like I said, a couple of banks are testing in very advanced stages of testing and should come in. The industry is trying to solve creative problems. This remained mostly in the lending and underwriting space. Over a period of time, this will get into, certainly into wealth management and other spaces. And it's a very, very active area with a lot of blogging, opinions, points of view, frameworks, architectures coming up for use cases. So across the board, whether you see banks and NBFCs, both active for lending and monitoring, brokerages because they need bank statements as users for FO account opening, that segment is opening up. Similarly, in insurance as an FIU. And wealth management will open up as and when the SEBI-regulated entities are prepared to offer their services from a depository mutual fund perspective, which hasn't happened yet. But from a bank account, balances, those kind of perspective, wealth management is already thinking of use cases. So lots of activity and excitement on that side. On the national pension, the CRA side, you know that we had got the license about a year back. We are about to launch for ENPS towards the end of the month. This means that our integration with a large set of POPs, pension fund managers, CRAs, trustee banks, etc., had to be done, which is all done now. Most of the testing is now complete. The user journeys, etc., are all completely enabled. Some testing is left, which will happen in the balance 2.5 weeks of February, but we are confident towards the end of early March, we should be able to launch the ENPS part. And then overall, you would have seen a lot of activity, consumer-centric activity coming from both POPs and PFMs in terms of promoting the product. This, of course, is the last quarter. A lot of this product does get bought for tax purposes. But we are seeing a lot of excitement. So like I said, we will go live for the all-citizen segment in about by the end of the month. And then the corporate sector through POPs in the month of March. MF Central, like I had stated, is a portal and a web property and a set of apps which provides a single interface for a mutual fund investor across his holdings, across all mutual funds, starting from looking at the holdings to monitoring the returns to in the near future, originating non-commercial transactions to commercial transactions, to watching the status of their complaints and queries across mutual funds, looking at a dashboard, etc. It creates a brand new paradigm. Like I said, the website was active earlier. The Android and iOS apps went live in December. The investor dashboard is available now. And then over a period of time, very quick, next maybe 8 weeks, financial and non-financial transactions should be available. And then the API architecture to service other entities in the mutual fund space will also be available for them to start showing things like gas in a unified way. and also then start sourcing transactions through this portal. So exciting times ahead for that. Overall then, I'm just moving to broad operating metrics for us in the third quarter. Our market share based on quarterly AUM was in the range of 70%. Net flows into equity, as you continue seeing in various press statements and releases, have remained positive throughout 3Q. Inflows through SIPs have gone up smartly, almost 9%, almost 5% successive months during the quarter. Riding on all of that, total AUM of CAMS scaled to 26.7 trillion rupees, up 28%, 28.4% year-on-year, and about 4.5% quarter-on-quarter. And then when you see equity AUM riding on both mark-to-market gains and sales across both lump and SIP segments, has gone up to 10.9 trillion rupees, almost upwards of 50% year-on-year, and 8.3% quarter-on-quarter. The industry AUM touched 38.2 trillion. Which is also, almost CAMS mirrored the industry growth, so that was 28.6 year-on-year, about 5.5% quarter-on-quarter. And similarly, the equity AUM across the industry went up just short of 50%, 10% quarter-on-quarter, 50% year-on-year. So smart growth across all the core metrics. And like I said, our transaction volume at 110 million was up 8% Q-on-Q, about 35% year-on-year. The SIP book at 2.81 crores, 28 million, up 9% quarter-on-quarter, 38% year-on-year. Systematic transactions processed almost mirroring that growth, 9% up quarterly, 43% up yearly. Live investor folios predicated on new investor participation and investors moving into multiple mutual funds, up 5% quarterly, up 23% year-on-year. You've seen these numbers. And then our unique investor service number crossed the 2 crore mark at 21.6 million, 18% up quarterly and 33% up annually. So that was really a commentary on the core set of operating metrics, what we saw in the market from an investor, transaction, assets, and accretion, that point of view. I will hand over to Ramcharan to speak about the financial numbers.
Thank you, Anuj. So I will just take a couple of minutes and give a snapshot of the financial performance of the Q3. From a revenue perspective, we ended the quarter with a revenue of 237 crores, which was up 27.8% year-on-year and 4.4% quarter-on-quarter. This almost mirrored the growth in the AUM that you saw, and hence the mutual fund revenue. Out of the 237 crores, the MF revenue was 215 crores, which was again up 27% year-on-year and 4.7% quarter-on-quarter. As we generally do, we split the mutual fund revenue into asset-based revenue and non-asset-based revenue. The asset-based revenue was at 179 crores for the quarter, which is up 26.5% year-on-year and 3.5% quarter-on-quarter. This again is tracking the growth in the AUM. If you recollect, the AUM grew by 28% year-on-year and 4.5% quarter-on-quarter. On non-asset-based revenue, this again grew 32% year-on-year and 12% quarter-on-quarter. The non-asset-based revenue, as you will recollect, includes the transaction revenue, the call center revenue. What contributed to the increase was the transactions recovered when compared to last year, and also there was some increase in the call center revenue. And as you would know, the last 2 quarters have been very busy from an NFO perspective, so there is some amount of NFO revenue that's come in the current quarter too. So overall, non-asset-based revenue grew nicely to 32% year-on-year. The absolute number for non-asset-based revenue for the quarter is 36 crores. The non-MF revenue, they have started recovering, and on a small base, there is a growth year-on-year of 32%, and on a quarter-on-quarter basis, a little more than 1%. The non-MF revenue mainly consists of the AAF business. We are seeing a lot of traction from an AAF perspective, where there is 25% of the non-MF revenue is actually the AAF revenue. And there is the CAMS Pay, which is the ACH and digital revenue that we have from our payments business. That's kind of doing well. That's kind of up quarter-on-quarter and year-on-year. And then we have the insurance repository, which probably contributes 20% of the total non-MF revenue. That's also up on a sequential basis and on a year-to-year basis. The CAMS KRA and the SSPL, which is our Sterling Software 100% subsidiary, the external revenue of SSPL plus the KRA revenue contributes to almost 25% of this non-mutual fund revenue. So overall, from a revenue perspective, we have seen good growth in the quarter compared to year-on-year as well as quarter-on-quarter, and the asset-based revenue tracked largely the growth in AUM. As we generally see, there is when there is a growth in the revenue in the assets under management, there is a small depletion that we see in the yields. But however, this is kind of kept within the overall trend. From the overall trend, there has been a small depletion, but it's not more than 1%. And over the long-term average of the last 6 to 8 quarters, the yields have remained broadly stable with a small fluctuation quarter-on-quarter. What has contributed to this in spite of the increase in AUM has been the increase in the equity component of the asset mix. As you will recollect, the equity is the higher yielding component of the entire AUM billing for us. So the equity component, which was around 34% last year, same quarter, and 39% last quarter, has come up to almost 41% in the current quarter. That's kind of offsetting the depletion that we would get because of the telescopic pricing structure. Overall, a very satisfactory performance from a revenue growth from an asset-based, non-asset-based, and a non-MF revenue for the quarter. I'll just give you a snapshot now of the profit and the EBITDA numbers. We entered the quarter with an EBITDA of 107.48 crores, which is up 41% year-on-year and almost 8% quarter-on-quarter. The comparable number for the sequential quarter was 99.8 crores, and the last quarter, the same quarter last year was around 76 crores. So this is, again, to clarify, calculated based on a conservative basis, which is the rent paid is taken as an expense and not the 116 or lease capitalization basis. If you went by that 116 basis, then the EBITDA would be a little higher than the 45.2% that we are showing here. The PBT again grew almost 35% year-on-year from 75.5 crores to 102 crores and 6% quarter-on-quarter. There is some amount of additional depreciation, as we have kind of informed in the earlier quarters also. We are investing heavily from a technology infrastructure perspective in order to ensure that we are fully equipped to handle the transaction volume that's increasing quarter-on-quarter. And we have kind of invested a little ahead of time to ensure that there are no problems on that. So there is a amount of depreciation cost that has come into the quarter because of the additional capitalization. But overall, a good growth on the PBT too. We are at 102 crores for the quarter as opposed to 75.6 crores for the last year. PAT again grew 37%. PAT margin is at 32%. We ended the quarter with 77.3 crores of PAT as opposed to 56.4 crores in the earlier year. Again, a good growth of 37% year-on-year and almost 6.6% quarter-on-quarter. Our return on net worth continues to be impressive at around 50%. It's been around this range for the last few quarters. And we entered the quarter with a healthy cash and cash equivalent balance of around 418 crores. The board has declared an interim dividend of 10.75 rupees per share in the board meeting that was held yesterday. That's kind of the record date is on 19th of February. I will just, if you see the trend of the chart that's given in the presentation, you may have a look at it. Just a couple of points I will just call attention to. One is the EBITDA that we have clocked for the 9 months of 294 crores is actually higher than the EBITDA that we clocked for the entire year of last year. Similarly, for PBT, the last full year PBT was around 274 crores, but our 9-month PBT is around 283 crores. And for a PAT, it follows a similar trend. The last full year, when I'm talking about year, I mean the full year PBT, PAT was around 205 crores, but the PAT for the 9 months is around 213 crores. So we have kind of surpassed the performance from a financial metrics perspective of the last full year, the current 3 quarters, 9 months. There are various charts in the presentation. I would urge you to have a look at it in terms of the trend of the operating revenue and trend of the operating EBITDA percentage, PBT, and PAT percentages. All of this is showing an increasing trend over the last few quarters. So this is broadly the snapshot of the financial performance, and I would now leave the floor open for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Puneet Kumar from Reliable. Please go ahead.
Good morning, sirs. Am I audible?
Yes, go ahead, please.
Am I audible? Mr. Anuj, Ram, it's a pleasure hearing such a wonderful performance presentation from both of you. And it makes us proud member of CAMS as a shareholder. I wanted to just ask one question, not related to the excellent performance that both of you or your team has delivered, but something that I have asked you earlier also. It's very difficult to find any company which grows by 30% both in flat and top line. But still, Warburg has decided to disinvest 25% of its stake. I would like to have a small word on it, in case possible. Otherwise, you can plainly say not decided by us. Thank you.
Okay. Good question. Just think of it this way that we have a set of investors in the company, and each of them comes with a different point of view. You know that there are strategic long-term investors who've been with the company for 20 years, over 2 decades. And of course, Warburg is a private equity firm, had come into the company in 2017, and will continue to take views in the market and views in a particular sector and an investment. You should also see that from the time an investor enters, one big pivot point for them is the valuations they are able to attain in the market. And I would say, as analysts, you guys must be seeing, since you track the market, that a lot of times for investors, there is a point of exit in terms of what return expectations they came with and what they got. We believe that that is perhaps the only lens to look at this from, and no other lens. They made a very sensible investment back in 2017. They've been able to get scale returns, and at different points they will continue to rebalance their holdings. That's the only thing I would look at. I don't think I would mix it up with expectations of returns in the future, etc. Because compared to the point they came in and compared to the price we IPO'd, there's been significant headroom available to investors.
Thank you so much.
Sorry, I would just like to add that they still continue to be promoters of the company, holding more than 20% of the share capital.
Agreed. Thank you so much.
Thank you. The next question is from the line of Priyesh Jain from Motilal Oswal. Please go ahead.
Hello. Yeah, hi. Hi. Just a couple of questions. Firstly, if I look at the yield, well, they have been flattish and it's a commendable job there. But I just wanted to understand, is there any negotiations going on with the AMCs for a future reduction in the margins, looking at your superior profitability and the pressure on profitability what the AMCs are witnessing right now? That is one point. And secondly, on the account aggregator piece of the business, while the banks, there's just 8 banks that have registered on your platform right now. But what are the talks with regards to other large banks, and by when do we see this scaling up to larger heights?
Okay, so I'll take your second question first. We'll talk about the yields and I'll ask Ramcharan to comment. So on the account aggregator side, essentially right now the RBI governed entities are participating over a period of time, and that period of time our expectation is should not be very long, should happen within this year, where the capital market entities and the insurance entities will also step in, because that is how the architecture has been. Four banks, which is HDFC, ICICI, Axis and IndusInd, have been active on account aggregator platform for some time. In the last about 3-4 months, Federal, KBB, AU Finance and IDFC Bank have added in. Now, these are available to all account aggregators to pick data from. What this means is that they are all now registered FIPs. You can go and integrate and start picking up data every time somebody gives the consent. There are 2 or 3 large banks which are in advanced stages of testing, like Kotak, SBI, etc. You read the names. As that number expands, this part will then become popular. So today, think of it this way, that on a particular website, a lender may give the option that you can upload your bank account. We'll also give you a button saying if you want to give a consent, if you're banking with one of these 8 banks, then you can come through the account aggregator route. It's for the individual to then either choose that route, but the number of banks as you're seeing is still limited, or still keep doing physically what they were doing. I think that sizzle, that change of habit, etc., will probably take a few more quarters, maybe another 2-3 more quarters to become entrenched. We're also seeing that consumers now, in order to monitor the bank accounts, are downloading the consumer apps also. So as all this momentum builds in, you'll find more and more banks getting active. Today that number is 8. And it is an equal participation with all the account aggregators. Any of the aggregators can pull data.
Okay, and the
So,
question is
Prayesh, if I can just take your question on yields. So you're right, the yields have remained flattish over the last few quarters, plus or minus 0.01, 0.02, kind of a small bit movement. What has helped is obviously the mix. Mix has helped in terms of the equity mix going up, and that's kind of beneficial to our yield. Specifically to the customer contracts, as usual, there are some contracts which do come up for renewal every year, and so on. End of this year, there are some contracts that will come up for renewal. We will stick to our stated philosophy, which is that if there is a growth of the assets in terms of outperformance in terms of asset growth, then there will be some amount of remissions that we will give. If there is nothing, then the remissions will not be substantial. These are, again, discussions and negotiations that will, as we speak, will have started and will happen till 31st of March. But just to kind of say, it is nothing unusual from the overall perspective, which is this is a negotiation that happens when the contract comes up for renewal, which is what is happening now. And we are sticking to our philosophy, what we kind of said earlier, in terms of giving remissions if there is substantial growth in assets.
Just following up on that, so earlier you were mentioning that the EBITDA margins, the one that you report, this quarter margins were at 45%. You were guiding for a 38 to 40% range. Would you like to upgrade that now? And this kind of delivery we've seen. And additionally to that is, earlier we had spoken about FT not breaking even this year. In spite of that, the profitability is really wonderful. So how do you see the margins going ahead?
Yeah, great question. So yes, we have seen the EBITDA margins inch up over the last few quarters. Our expectation was in good quarters, it will be in the early 40s, coupled with some good cost initiatives that we have taken in terms of automation and in terms of other things that we have done internally. The cost management has been very good over the last few quarters, hence it's kind of little more than what we expected. However, from a long-term perspective, we would continue to hold the view that in a good quarters, it will be in the early 40. That will be what we will continue to hold the view on in terms of the EBITDA margins. In terms of FT, while we don't give specific margins, I think FT has done a little better than what we expected in terms of overall margin expectations. However, it's not very different from what we projected. The operations have stabilized, and we don't see any reason why we should have a longer view in terms of it going break even. I think it's close to break even now, and we are in line with expectations.
Thanks.
Thank you. The next question is from the line of Anshuman Dev from ICICI Securities. Please go ahead.
Yeah. Hi. Thanks for the opportunity. My question is, I have two questions. One regarding on the MyCams app count that you share, and it's the most investor preferred app. Would you be able to share some light in terms of how does it compare with some trading or / investor apps which are there from some players like Grow and all? How would that compare with our traffic in MyCams? If you have any idea of that, that is one. And secondly, in terms of the pension revenue, you said that the total pool is around 170 crores, but we are part of the citizen segment. So some monetization trajectory for that pension plan going ahead, if you can share some color on that.
Sure. So let me answer the first question. First on MyCams. MyCams is right now just short of 5 million registered users, which is about 50 lakh. And like I said, about 1 crore active sessions have been seen at the highest in terms of investors using it. In its basic character, it's a pure mutual fund, non-advisory app. So like from our stated philosophy perspective, we have created utilities which help investors execute their decisions, but we do not bring them to the decision point. We don't compare asset classes or direct equity versus mutual funds, etc. When you look at the fintech apps, obviously that's their objective. They want to play in the advisory and execution space. So they will pick out which assets other consumers are buying, how are metals compared to direct equity, compared to mutual funds, etc. We don't do any of that part, and that's scope restrictive, but that's our philosophy because we want to continue remaining entity neutral and business neutral. From a numbers perspective, you know that subscriber numbers are now broadly known across the markets. This is the largest app in terms of consumer franchise size and was the largest till some time back in terms of quantum of transactions. That's an easily measurable thing that we can see. Over a period of time, from a consumer number perspective, it continues to be the largest. Of course, the fintechs will do what they have to do. And obviously, they have a lot more variety in terms of asset classes, direct equity, insurance, all of those things, which we don't do and are not allowed to do on the app.
On this part, I just want to understand that, one way of possible diverting this traffic to some monetizable way could be MF Central. That is, if at some point down the line, if there is a financial transaction, as you said, would come in. So, that would naturally be a kind of a cross sell or kind of a thing to the MF Central.
I think philosophically, MS Center will remain the same. It will not become a recommendation engine. It will not have algos or bots to predict what asset a consumer should buy. It will remain a transaction-only app. But yes, under the architecture, it is allowed to charge. All of that is emerging. We should be able to tell you a lot more concrete stuff in the next quarter when we come back on how MF Central's charging methodology will pan out. But from a philosophy perspective, it will remain mostly on the non-advisory side.
Understood. And on the pension part?
On the pension part, what is happening is that you saw that number of about 170-180 crore overall, which is the revenue base in the market. So there are 2 or 3 things which are happening. One, of course, is that pension is becoming an actively sold product. There was a time when you only bought it through the employer, but now you would have seen, if you just see how banks and PFMs and others are promoting in the last 6 months, you'll find that everybody is trying to put a proposition out to sell. That's one. Secondly, the direct plan, which is the all citizens NPS part, the ANPS part, is becoming popular. And especially popular in this quarter because a lot of people buy pension for tax saving. As we get in, we are expecting that through techniques of demand generation, etc., and communicating with individual investors, we should be able to build a momentum on the ENPS side. Corporate business has to be built through the POPs or the points of presence. We are integrating with them. In most, we will be one of the 3 CRAs available, and it depends. It depends upon time to see how they are able to apportion traffic and what fraction of the traffic we get. Government, like we've said in the past, is a long lead item because it takes time breaking in and getting a decision out. So that's really where we are. I think in the initial days, we're not expecting our volumes to cross more than 4,000-5,000 a month. And over a period of time, of course, these volumes will scale as we start acquiring corporates. So think of it like that. It will have a revenue build out, let's say, starting from the months of March, April, and will slowly grow. Initially, it will be largely ENPS. That market isn't very large. That market is of the order of a few 10,000s a month. So we are expecting that we should be able to get to a few thousand a month in the initial period in the first 3-4 months, and then we will scale from there.
And one last question to Ram sir in regarding this, the EBITDA margin that you said. So, this after Ind AS, the kind of margin that we have seen, a part of the increase is also because of the transition to this Ind AS thing, right, from our pre-IPO times. So I'm saying that going back to 40 structurally is like, because we are now way above, we are 47.7. So, if you could share some of the thought process as in why we think, these margins right now is not sustainable. It would be good.
Sure, Anshuman. So we would obviously like it to be sustainable. We would obviously like to maintain the margins, no two ways about it. But then this is something to do with the long-term trend that we have seen in the past. So historically, what we have seen in the last 10 years, we would assume, from a margin perspective, unless there is a big re-rating that happens, would actually play out in the next few years also. That's the philosophy behind that, and some of these cost catch-up will happen in the next year in terms of the salary increments that happen and in terms of the other investments that we do. Although it may not be substantially high, but there is some amount of cost pressure that we will get in the coming year. And the assets growth you have seen has been phenomenal in the last few years. The long-term average for the asset growth has been projected to be X. It's probably less than 20%, so it's 17%, 18%, or probably 14% if you take a more conservative view. So building all those things into the picture and also accounting for some amount of operating leverage, but also the additional investments that we will need to keep doing from a technology perspective, from a platform building perspective, and from in terms of the assets and IT infra that we need to build. So all those things put together, we feel that there will be a balancing out at some point of time, and hence our long-term view is what the past taught us, which is around the early 40s. However, we'll be happy to beat that. Obviously our endeavor is to keep retaining the margins, but these are the other factors that you need to consider.
Yeah,
I'll only add to this. If you see last year, and obviously only 3 quarters have been declared, but if you drew the trend line, it's a year of significant revenue expansion. For the period prior to that, if you started with JFM of 20, so if you took 5 quarters, there was hardly any revenue expansion like you've seen the numbers. So it's been a year of significant revenue expansion. It's been a year of significant work expansion because as our transactions, records, etc. grow, investors' expectation is of instant service, and therefore we did put in a lot of money in capex to spruce up the IT infrastructure, the security capability, and the risk and compliance infrastructure. So we've had I would say, a significant revenue growth after a long period of time. We made the right investments, and some of that would have helped the margins to creep up. Now, what we have to see is that years of supernormal revenue growth will not happen every time. It will be back to normal revenue growth, in which case, as Ram said, we are expecting that we should be in the 40%, maybe early 40s range. And this was perhaps a little influenced by a much deeper revenue growth, which came within a space of 4 quarters.
Right. And our employee, you think it will increase?
Sorry, can you just come back? You're not audible, Anshuman.
Yeah, no, I was saying that the employee count would that also increase or the cost increase that you see more on technology, or employee count will also increase?
No, more on the tech side. More on the tech side. The employee count is going up, like we've said, only in select areas. Not in the front offices, not too much. Not in the processing side, because we continue to automate and find a more systemic way of solving problems. So employee count only goes up in those 4 or 5 areas, like I've said in the past, which is technology, both infrastructure, designing and coding, and in risk, compliance, cybersecurity, analytics, those areas. Those are not very large counts. So you will see that we have kept, for a long period of time, our employee headcount remains within 7,000 plus minus 500, despite the galloping of assets and the records and transactions. The large investments come mostly on the tech side.
Thank you.
Thank you. Before we take the next question, a reminder to the participants. If you wish to ask a question, please press star, then 1 on your touchtone telephone. The next question is from the line of Paras from Samco Mutual Fund. Please go on.
Hi, good morning. I have 3 questions. The first one is that, the past recent trend is that the new players, new entrants in the MF industry are going to the competition, and now there are 2 new accounts up for the grabs. So what will be the strategy to acquire these new MF entrants? Second question is that post 31st March, transactions from the pool account will not be allowed. So what could be the implications on the number of transactions and consequently on our transactions linked income? And the third question is, competition has recently acquired businesses offering fund accounting and reconciliation services to build a comprehensive solution offering and strengthening product portfolio. What is the policy on such acquisitions and making CAMS a comprehensive player? Thank you.
Sure. So let me tell you that as far as new logos are concerned in the marketplace, new MF logos, for a long period of time, most of the new significant logos have all come to CAMS. You can look at that over the last 5-6 years. Even in the recent times, it's only when an entity or a new age fintech entity has gone and bought an existing mutual fund, the ones that you're referring to, were buyouts, and buyouts typically continue with the same RTA. They don't come back to the market for an RTA churn. Otherwise, including FT, recently in 2020, and if you go back, most of the significant brands have all come to us. So, and you can do a name-wise comparison. The 44 names are published on the website, and you can take a look, or you can do a separate conversation with us, and we can help you understand. That's point number 1. Point number 2, as far as pool accounts are concerned, what has come out from SEBI is that pooling of accounts and mutual fund units will not be allowed, and one-time mandates will be restricted to only certain kind of entities. That will not have any impact, or we don't see that having any significant impact on us. In the end, it's a consumer's transaction which will have to happen. If this exact decision were to be implemented, then obviously only the AMCs are allowed to have one-time mandates, and that dispensation could come in. If the current dispensation is allowed with some, more ironcladding and stronger practices, then the one-time mandates will continue. But think of this way. When you do a transaction, whether you're paying through a one-time mandate or you're paying through UPI or you're paying through NEFT, RTGS, any form, including your debit card, all the processing anyways comes to us. So that will not make a significant difference in terms of how the processing happens, and in terms of transaction revenue, it will be completely neutral. That's point number 2. Point number 3, you've said that our competitor has gone and made an acquisition. So obviously they will make acquisitions wherever they feel that, or it's completely their decision in terms of what they would like to acquire, but wherever they want to fortify their suite of services, they will certainly do this. As far as you can see, CAMS has been the market leader this is largely to do with the AIF PMS market. CAMS has been the market leader for a length of time now, servicing over 120 AIFs and PMS companies. 15 of them, like you saw, have now bought CAMS Wealth Serve, which is a composite solution to bring in paperless onboarding, including doing stamp paper, e-signing, etc. So that's a proprietary solution. The companies are coming in, including for the gift city, etc. So we already have a comprehensive solution in place in the marketplace. As far as reconciliation is concerned, our product Recon Dynamics has now been in the market for over 2 years. Servicing home finance companies, insurance companies, and also now on the capital market side, doing 3-way and 4-way reconciliation wherever. Single orders are placed and they have to be segregated at the end of the day, etc. by PMS companies. That product is already available. So we've had these things available. They are in the market. They're being sold. And if someone else wants to fill up their product suite, obviously they must do that.
Okay. Thank you.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, if you have a question, please press star then 1. The next question is from the line of Arvind Datta, individual investor. Please go ahead.
Yeah, hi, good morning to you. My question pertains to the account aggregation business. Could you throw some color on how this is progressing? Is it live, the number of transactions you've had in the quarter, and how is the growth month on month looking, or what exactly do you foresee in the next 3 to 4 quarters in this business?
So think of this business this way, like I said, there are now 8 banks live. So that's a rich offering on the account aggregator platform from a bank perspective. It will help when people like SBI come in. So give it another maybe 2 months, maybe give it up to March, April. And you will find that suite will be in a good position. And therefore, if you as an individual investor or individual loan seeker would like to engage with a lender, it will be easy for you to just give us a consent and get your accounts, etc., given out to that entity, rather than you take downloads and then take printouts or save the images and upload them somewhere, which is a very cumbersome process today. So from a macro perspective, the banking and non-banking entities are in the right direction. It's a slightly slow momentum, but in any such habit-changing initiative, those delays can happen. But I would say overall that's progressing at a very good clip. The capital market entities haven't yet got a formal sign-off. They should at some time. Right now they haven't got. So that may happen over a period of time. Same with the insurance entity. But you can believe that those events will happen, whether they happen in a few months or many months, but because everybody is a signatory to this architecture, that will happen. How do you make money? You make money by driving transactions. How do you drive transactions? You onboard entities on your AA platform and you onboard entities on your TSP platform. You do these 2 things, and when they start transacting, then you make money. Like we said that, and here, onboarding an entity for both TSP and AA is considered a kind of a rich combination that a company should seek to achieve. You saw that there are 10 entities of different kinds, home finance companies, brokerages, banks, largely those 3 or 4 kinds, who have chosen to sign up with us. We are in an advanced stage of implementation. Number of transaction count, etc. is small. It should start building out in the months of March and April. And as this habit change happens, we believe that, let's say, 6 or 9 months from now, a lot of investors will start opting with this being their primary form of data sharing with lenders and with wealth managers, etc. Today it's a new concept, but it will take momentum soon. That's the right way to look at the market.
Thanks for a detailed answer. My follow-up question is that
how many competitors today are there in this space in the account aggregator business? And can a bank be with multiple aggregators, or how does it give you any competitive advantage vis-a-vis competition?
It's a fairly open market right now. There are 5 licensed entities for account aggregator. You need a formal license. 4 are live. The 5th should be live in about a month and a half. So think of it as 5 licensed account aggregator entities. And then on the TSP side, there are multiple entities. It is not licensed, so I can't give you a formal count, but when we see various bids, think of it as about 17-18 people who are active in the marketplace. The account aggregator license is on tap. TSP, like we said, is not licensed yet, so anybody who chooses to come in, algo companies who are trying to create API gateways, technology companies, all kinds of companies have participated. So the best man will win. Of course, brand, reputation, past experience in financial markets, etc., are all very useful assets to have. We have them. But it's not limited by license kind of a market.
Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Kaushik Agarwal from Haitong Securities. Please go ahead.
Yeah, hi sir. Good morning. I hope I am audible.
Yes, you are. Go ahead, please.
So, sir, I have 2 questions. So, firstly, on the AIF side, since you said that we are the market leader, so can you just give some numbers around what's the current market share? Because earlier, I think you used to mention the AUM which you are managing in the AIF business, which we do not find in your current PPT. So, around that piece, if you can mention. And sir, Ram sir basically mentioned the revenue breakup of the non-MF piece. So, was this for the quarter of this quarter, or was this for the 9 months? And if we can get the some sort of PAT breakup for this piece of business as well. And so the third question is mostly a data keeping point. So I wanted to know what would be the component of ESOP cost in your employee expenses for this quarter and for the 9 months.
Okay, good. So AIFs first, think of it this way, that there are about 400 to 500 registered AIFs in the country. Not all of them outsource. Our total count of pure AIFs would be 100 plus that we service. And our total assets would be in the range of about 90,000 to 1 lakh crore. On the outsourced market side, we are easily more than 50% of the market. I can't give you reliable, authenticated bureau numbers or industry association numbers because they don't exist, but this is a broad understanding. And like we've said in the past, we are now seeing a lot of AIFs wanting to outsource again in the last maybe 4 months after November, given the fact that money raising has come back in a big way and a larger number of investors are joining them. So broadly, unofficial numbers, upwards of 50% in this market. Over 100 AIFs work with us. That's the answer to your first question. You want to take the ESOP part?
Sure. So from an ESOP perspective, the cost that has come into the books in the current quarter is around 7.5 crores. That is the cost that's come in. And from earlier quarters, we had around almost 9 to 10 crores of cost in the earlier 2 quarters. So overall, it will be around 17.5 crores of ESOP cost is in the books. That's the number that you're looking for, I hope.
Yes, sir. Yes, sir. Sir, thank you for the answer. Sir, just a follow-up question to the AIF business. Sir, if you can just give some color on the yield part in the AIF business, like what kind of delta are we making when we compare it to the MF business for CAMS?
So while we don't give segmental financials, and I'll just tell you broad indication is that the work is a little less intensive from an AIF perspective. So you would expect the yields to be a little less than that. But from a profit perspective, they are extremely profitable. MF like EBITDA margins is what we get from AIF.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Saurabh Dole from Trivantage Capital. Please go ahead.
Yeah, sir, good afternoon.
I have two questions. So firstly, I just want to know what kind of changes do you think the yield on your mutual fund AUMs will be in the next 3-4 years? As in, what kind of trend does it have? Because I think in the initial commentary you said that, when a particular mutual fund grows its AUM, you're ready to give them some tariff concessions. So given all these factors, how do you think the yield will move in the next 5 years?
Okay. So in terms of trend, while forward-looking statements we don't generally give, but there are enough and more material in the public domain, which and enough studies done, which point towards at least historically and in future we expect that the growth would be around 14 to 15% CAGR, probably going up to 20 in case it's a good period. So that's the growth that the mutual fund generally is projected from a mutual fund assets growth perspective. Going by the past, our growth in fees, there is always a lag to that. There is a 70 to 80% of that gets realized as fees from an AUM perspective for the reasons that we have explained in the past, which is the telescopic pricing, there is a yield mix that happens, price reduction that happens. So we would expect that will be a good indication in terms of future growth of fees as well as for AUM.
Okay. And the second question is, how do you think this non-MF related revenues in your revenue profile will look like, say, 5 years hence?
So you have seen that we have upped the ante on all the core offerings where we see scale in the marketplace, particularly on the AIF PMS side and on the CAMS payment side. And then definitely now on the NPS and the account aggregator side. Overall, we are targeting all of this to contribute to, let's say, 20% of the overall revenue book, upwards of 20% in a 4 to 5 year time frame. Right now, like the strategy has been largely building things out and taking them to market. So build the product, build the strategy, and then build the go-to-market. We haven't really done anything inorganic of any scale yet. But that's how the thinking has been so far. But we are very focused on building out teams, products, and markets for non-MF. And over a period of time, we do expect that this number will certainly grow.
Sure, sir. Thank you so much.
Thank you. The next question is from the line of Dipanjan Ghosh from Kotak Securities. Please go ahead.
Hi, sir. Good morning. Two questions from my side. One is, you mentioned that, if you look at the deal wins over the past maybe 5-6 years, most of the large AMCs have probably come with CAMS, or the market share has also expanded. But correct me if I'm wrong, I think your market share of around 10% increase that we see over the past 5 to 6 years is broadly because one of the largest players has gained equal amount of market share in the business and maybe led by some amount of institutional money also out there. If I look at the equity mix, core equity mix, probably the smaller players on an overall basis continue to gain market share irrespective of CAMS or your competitor out there. Under such a circumstance, in terms of new deal wins barring Franklin, probably CAMS has been a little bit on the softer side. So, if you can shed some light on your strategy out there incrementally, given that some of the smaller players probably may gain market share given their size, and they will probably be a little bit yield accretive also given the size and scale. My second question is on the yield part, and again, going back in time maybe to around 2015 to 2017 sort of a period, where the yields compressed by nearly 90 to 100 basis points when equity mix was broadly flattish around 27-28%, and AUM growth was probably holding up well at around 25-30%. Given that today equity as a proportion of the mix is anyways high at around 40-41%, and assuming it remains flattish out there over the next few years, how should one think of the yield trajectory under such a circumstance when equity mix remains flattish and the book probably, or the yield probably is more linked to a higher proportion of equity compared to what it was in that 2015 to 17 sort of a period? These are the two questions.
Sure. So, think of it this way. I'll just give you some numbers for you to absorb this entire thing. 2016, our aggregate market share was 60%, 60 and some change. Grew to a high of about close to 71%. And that was almost secular quarter-on-quarter consistent growth. And that was a time, like you know, that newer launches by AMCs did not count for much. Even if you see the ranking today, outside of one, any AMC which was launched in the last 10 to 12 years has not made it to, let's say, the top 15 ranking, because that itself has a cycle time. That's point number one. Point number two, I don't think it's a surrogate distinction to think that smaller fund houses are better or are doing better fund management. That's just an element of surrogacy in terms of how their fund management techniques can pan out, large ship versus small ship, which one do you turn faster? If we were here in 2020, we would have been talking about a trend of brands, distribution, and return to safety of investors. And today we are talking of just the opposite, none of those three things, but we are talking of is the smallest one better, and therefore if you have the smaller guys in your franchise, are they the best? I don't think any of these is a secular long-term view. One thing which has certainly happened in the market is that mutual funds are morphing from sold products to bought products. From a sold product perspective, you can say that distribution alone counts. And today you can say that as far as the bot part is concerned, a lot of people are just looking at digital rankings. And some of them may believe that metals will do better than equity and they may move their en masse. Similarly, they are just looking at a curated list of funds. And I wouldn't even say they're looking at, perhaps not looking at fund houses that carefully as they're looking at funds. This was just a different habit 3 years or 4 years back, but they're looking at fund houses more closely and said, okay, I know this name, even if I get 1% less or 1% more, I'll still go with that. That habit is probably changing. Happens in every such market, not just financial markets, where investors start taking decisions based on a very immediate 6-month, 9-month ranking, etc. And individuals will be individuals. So I would say it is perhaps not accurate to define this as one player which drove the entire marketplace. Yes, we know who you're referring to, but the numbers don't vindicate that completely. I think it was a very broad-based growth. Only in the case of corporate monies was it a return to safety and return to brand. And slowly in the larger retail-led equity markets, it has been now that the best fund house or the best schemes or the best categories are winning. And you know how those screens look like when investors are looking at them and how they take the decision. So in the future, I don't think much is going to change. Distribution will continue to play a role, brand will continue to play a role, and the new guy in the pack, which is looking for the best performing fund, irrespective of the brand, will perhaps also start playing a bigger role. Within that, the best guys will win. I would not restrict it to large versus small, etc. And there are always times when investors do prefer safety, especially on the corporate side. I don't think that trend is fundamentally going to change.
Sure. And on the second part, on the yield part?
No, so on the new build side, I suggest you have, I don't want to start giving out brand names, etc. in this conversation. I suggest you have a separate conversation with us. And since the names are finite, and they are all available publicly, we can show you which names and who's got them.
Sure, sir. I'll definitely connect with you.
Yeah.
Okay. Dipanjan, on the yields, I think your question is more to do with what will happen to the yields as the assets grow. So you will know, and I know what your views are on the yields of CAMS, but I'll just throw a couple of data points out to you there. See, the model calls for a telescopic pricing, and that's what we have been doing for quite some time. That's the basis in which the entire mutual fund pricing works. So inbuilt, there is some amount of yield depletion that will happen as the assets grow, and I think that is 101 of this entire model. But having said that, if you take the last 7-8 quarters, for example, and then you go and do your yield calculation as you can see last quarter. So what happens is you see kind of a flattish kind of a trend. So in the you've seen some 5 lakh crore worth of assets grow over the last 1 year, and a lot of them have been equity. And you see that the yields have kind of remained flattish, could be a percentage up in a particular quarter, down in a particular quarter. But if you see as last 7-8 quarters, it's been kind of around the same range. So that kind of leads us to, and there is a complex interplay here. It is not only the growth of assets and telescopic pricing. It's not only the equity. Definitely, they play a very important part. It's also kind of which customer is growing and marginal billing for us from a particular asset class and asset customer. So, but what we have seen from the last 8 quarters is that while there is a small depletion that happens if there is an subnormal or growth in subnormal, I mean what I mean is a higher growth in assets than what we generally see. Over a period of time, the yields have remained flattish, and there is nothing that actually indicates that it will be very different going forward. Yes, we will see small depletion in yields as we go forward because of the telescopic pricing, but there are some offsetting factors that also play around. So. That is our view. We don't expect a big depletion in the yields. There could be small depletion quarter on quarter depending on how the assets grow and how the mix works. But we don't see something which is going to kind of change it drastically.
Sure. My question was more from the perspective that, what if the equity mix remains flattish? To some extent, my understanding is in the past year, maybe the equity mix would have increased from 600, 700 basis points. And that's what I'm saying, if I go back in time and look at the 2015 to 17 period, when AUM growth was probably similar to what we are seeing today, at least for the last 3-4 quarters. But the only difference was equity mix remained flat. In that case, we probably witnessed a 90 to 100 basis point shrinkage in yields, maybe a little bit less, 85 to 90 basis points. So if the equity mix remains flat, is there a case for yields to compress at a faster pace? That's what I'm more coming from.
From a numbers perspective, you are right. If the mix remains, because equity is the highest yielding asset for us, so if the mix remains constant and the assets keep growing, and the other class of assets, which is lesser yielding in terms of, say, debt or liquid, keeps growing at a higher pace than liquid, then mathematically, absolutely, the total yields, there will be a compression. But as I said, there's an interplay of few other factors also in terms of, what kind of, what stage the customer is in, whose growth is happening, etc. So it will be very difficult to give a straitjacket answer, but philosophically, you are absolutely right. If the asset growth is more on non-equity assets, then your yield would come down.
Sure. And maybe if I can squeeze one more question on the non-MS business, the account aggregator business. If I keep the TSG business aside and just look at the basic FIP and FIU business out there, and I think we have discussed this sometime before also and also in the call. Over a period of time, do you think customer acquisition becomes a key aspect of this business? Because ultimately, if the customers and both FIPs and FIUs can be there on either of the account aggregators, the ones that are currently live and the ones that may go live. So ultimately will the industry become more and more competitive given that it's a free play out there for now?
So if we just peel the onion a little, I think being a TSP for someone, and don't put me outside this meeting, gives a provider disproportionate influence on which account aggregator gets used. Okay? Because you are the core architect, you are the integrator, and you're defining or helping define, not defining, but helping define which account aggregator gets used. That's point number one. So there's a beeline in the market. Why are not so many people wanting to be account aggregators? Why is everyone wanting to be a TSP? The answer is clear. Over a long period of time, if there's 100 rupees of revenue in this market, today it looks like 80 will go to the TSPs and 20 to the account aggregators. But we won't be surprised if 2 or 3 years from now it's 85-15 or 88-12 or something, which means the size of the pie of the account aggregator is smaller and the size of the pie of the TSP is larger. That's one thing which will certainly take place. The second is, will this business, and I'm just wondering if I understood your question correctly, on whether having your own consumer franchise, let's say we have an app and we have 1 million downloads, will that influence the choice of the account aggregator? Yes and no, because it can still happen that the bank that you're dealing with has account aggregator A, and that's the only thing that shows up in the app. If you want to work, you'll work through them. If you want to give your consent, you'll give your consent through them. If you have app D downloaded, that will not influence the decision there. That's the point of view right now, which means even if you built a very large consumer franchise, can you start influencing lending decisions in a material way? Today the answer does not look like it is a yes. But yeah, I mean, that's a hypothesis some people do carry, the question that you're asking. The market has to turn out in a certain way. We continue to look at it, but today it looks like a B2B choice of TSP and a B2B choice of account aggregator is probably going to define who gets used for a particular transaction.
Sure, I think that was helpful, and all the best.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Ramcharan SR for closing comments. Thank you, and over to you, sir.
Thank you, and thank you all for attending this call. We appreciate your interest in CAMS. Please do reach out to us in case of any questions, either to the email ID on the presentation or to our IR agency, Orient Capital. Hope to have you back in a call soon. Thank you.